Alright, let's dive into something that's been buzzing in the economic world lately. The US ADP employment change for week average dropping to just 8.25K. Now, before you glaze over thinking this is just another boring economic update, let me tell you why this is actually a big deal. Personally, I think this number is a canary in the coal mine for the US economy. When private sector hiring cools down like this, it's not just a blip, it's a signal that businesses might be hitting the brakes. And in my opinion, this could be the first domino in a series of economic shifts we're about to see. What makes this really interesting is the timing. Late July isn't typically a slow period for hiring, so seeing such a sharp pullback from the previous 11K average is surprising. One thing that immediately stands out is how this ties into the broader labor market narrative. Labor market conditions are like the pulse of an economy. They tell us how healthy or sick it is. High employment means more spending, which fuels growth. But here's the kicker. A tight labor market, where there aren't enough workers to fill jobs, can also spike inflation. Why? Because when demand for labor outstrips supply, wages go up. And as we all know, higher wages often mean higher prices for everything else. From my perspective, this drop in hiring isn't just about jobs. It's about inflation, monetary policy, and even currency valuation. Take the US dollar index, DXY, for example. It's been clinging to its gains, trading just below 100.00, and this employment data is part of the reason why. What many people don't realize is that labor market data is a key driver for currency movements. If employment weakens, it could signal slower economic growth, which might weaken the dollar. But right now, the dollar seems to be holding its ground, which raises a deeper question. Is the market underestimating the impact of this hiring slowdown? Now, let's talk about wage growth, because this is where things get really fascinating. Central banks, like the Fed, obsess over wage growth because it's a sticky form of inflation. Unlike energy prices, which can fluctuate wildly, wage increases tend to stick around. If salaries keep rising, households have more money to spend, which can drive up prices across the board. But here's the twist. The Fed has a dual mandate: maximize employment and stabilize prices. So, if hiring slows but wages keep climbing, the Fed's in a tough spot. Do they prioritize jobs or inflation? Personally, I think this is where things could get messy. If you take a step back and think about it, this hiring slowdown could be the economy's way of cooling off after a post-pandemic hiring spree. But what this really suggests is that we might be entering a new phase, one where businesses are more cautious and the labor market isn't as tight as it once was. A detail I find fascinating is how this contrasts with other economies, like the Eurozone, where the ECB's sole focus is inflation. The US has to juggle both employment and prices, which makes its policy decisions way more complex. So what's the takeaway here? In my opinion, this drop in hiring isn't just a number. It's a symptom of broader economic shifts. It's about inflation, monetary policy, and even global currency dynamics. And while the dollar seems strong now, I'm keeping a close eye on how this plays out. Because if hiring continues to slow and wages keep rising, we could be in for some interesting twists. What do you think? Is this just a blip or the start of something bigger? Let me know in the comments. I'd love to hear your take.